My guest today is a chartered financial analyst, economist, and one of the top-rated financial bloggers on Seeking Alpha. His new newsletter is called The Data-Driven Investor, which can be found on Seeking Alpha. Andre Cardenal, thank you for speaking with me. How are you?
Oh, thank you very much for having me.
I appreciate your time very much. Obviously, this is a very unique time in history, and
Indeed.
the markets obviously react, very negatively to uncertainty, and then speculation is something that is sort of rampant in markets as well. We've seen extreme positives in the past week as well, and still uncertainty right now. Do you have any just general feelings we can start with right now before we start talking a little more about Disney, which I'm curious to hear your thoughts about? How
Mm-hmm.
are your feelings about the markets these days?
I have, I started reducing my exposure to stocks in January, but not because of the COVID risk, mostly because there was just too much complacency in the market. Everybody was long and everybody was optimistic. When you look at the sentiment indicators, when you look at fund managers, when you look at the magazine covers even, Barron's was saying down 30,000. The economists had a cover with the big tech companies, like with a bullish perspective. So in those kinds of environments, you know that the market is vulnerable. A lot of bad things tend to happen when everybody's expecting too many good things. So I went to 50% in cash back in January. Then with the things started to change, and we did not have just like a pullback in a bear market. We went to a full-blown bear market with a recession. So that's a completely different environment. I increased my exposure to 70% in stocks as markets decline. And then with the big rebound, I am currently 55 or 60% in stocks. I was 55, but the stocks, they appreciated, so probably 60% in stocks, 40% in cash. For me, that's a conservative allocation. I think that it makes sense to keep your risk levels low at this time, because most of the time what happens is you have a big panic sell-off. When you look at history, you see a big panic sell-off, then a relief rally,
Yeah.
and then you get into a phase with a lot of sideways volatility, maybe a retest of the lows, which is the market does not have to every time retest the lows, but it happens more often than not. Maybe even if we don't retest the exact lows from March, I think you need to be prepared for some volatility. It wouldn't surprise me if we see the market turning around once we reopen the economy, because what we have seen is that prices have been trying to anticipate everything. Like the market crashed when everybody started to understand that we're going to get the lockdowns and the shelter-in-place measures, and that was going to be really bad for the economy. And then when the COVID-19 data started to improve, it seems to me like the market had a massive rally in anticipation of the fact that things were not as bad as previously anticipated, which is obviously a very good thing. But it's already incorporated in prices, I believe. So I would not chase the market at this level. I think it's better to keep a big cash position. And in any case, just be prepared to buy on market pullbacks. That's my main approach right now.
Right. No, that makes a lot of sense, because it seems to be, and some people will comment that technology, automated AI type trading is going to create faster movements in prices on Wall Street. But so now, is there almost too much excitement when you see some of these very positive days? I think last week, was just a very bullish week. So is it almost back to a point where you're holding back to wait and see what happens, because we still have no idea if especially the US, but the global economy is going to be able to reopen for people to go out and spend money?
Yeah, that's right. I think in the long term, we're going to get through this. I mean, this is not a virus from another planet. It's quite similar to other viruses that we have faced in the past. So we're going to have treatments and we're going to have vaccines, and the world is going to be better prepared for new waves of contagions or whatever might happen. But in the short term, I think a lot of of good news is already incorporated into prices. Mostly the two main drivers are the fact that the Fed is doing anything it has. I mean, short of buying stocks, they are doing anything they have. And I think they're acting well, but this is already pretty much incorporated into prices. And also the fact that the hospitalization data, the contagions data, all those key data points, they are improving in New York mostly, which is like the key epicenter. So I think the market is current prices are kind of incorporating the fact that the economy is going to go back to work sooner rather than later. I don't think too much in terms of market timing, but rather how much risk do you want to have in a specific market environment. Right. So I was having very little risk back in January. Then I increased my risk when the markets went down like 30%. That's a good time to have more exposure because stocks are much cheaper. And right now, the stocks are not particularly very cheap, at least not the big high quality stocks. They are not particularly cheap. Right. You can find many cheap opportunities in specific sectors such as banks, maybe energy, maybe consumer discretionary. You can find cheap opportunities in small caps and also in international stocks. But the kind of high quality stocks, mostly in technology, which are the ones that I try to focus in, they are not particularly cheap. So we're not in a market environment in which I am going to aggressively be increasing my exposure. I would rather keep my position in long-term stocks which I really like. I am not planning to sell them regardless of what happens to the market in general. And I also want to keep a lot of cash at hand in case there are more opportunities in the near term.
Yeah, that's excellent. So speaking of like high quality companies or excellent companies, then we chatted a little bit about Disney. And I know you've written quite a few articles over the years on Disney, including recently. And you're very positive on the company long term, which makes sense. They're a very well established business that is very profitable. But so what keeps it a buy at this point? With people, even when people get back to work, money's tight. The parks they're not cheap. I've never been, but it's expensive to go. So you're still very positive on Disney going forward. Is that what you feel about it based on what you see?
Yeah, I think Disney is a risky position right now. You need to balance your risk. For example, I have some stocks that are benefiting from the pandemic, like DocuSign and Amazon. I have big positions in those names. I also have other stocks that are suffering because of the pandemic, and that they have a big potential for appreciation once this is over. Disney is in that group. Disney is a company that's going to suffer the pain because the parks are going to be closed. There's going to be no cruises or hotels. Also, a lot of the assistants to the parks, they are tourists, and that's not going to come back anytime soon.
Right.
But there's like a time arbitrage opportunity there because I increased my position in Disney the day they announced that they were closing the parks, because you always have to think about what is already incorporated into prices. In the case of Disney, everybody knows that the parks are closed, the hotels are closed, so are the cruises. They have stopped the movie productions. So this is already incorporated into expectations. What's going to happen with Disney over the next 1 year or 3 years? I think there's a huge chance that all those variables are going to improve.
And so there's no surprises in stock, basically. Like there's no hidden surprise. Disney's not going to go bankrupt, and it sounds like it might be negative, but at least everybody knows it, and the market knows it, and it's probably priced in.
That's my big point. And at the end of the day, when you look at the big picture, Disney is probably the most powerful company in the entertainment industry. They have enormously valuable brands. They have the most valuable characters in the industry. Content is king. And you see, for example, they are booming in the streaming service. Of course, that's not going to compensate the weakness in other services, in other areas of the business right now. But over the long term, they are going to keep the streaming subscribers, and their packs are going to come back. probably not to full revenue
Mm-hmm.
in the next year, but over 2 or 3 years they will.
Yeah.
So if you can, keep the position size small in case it goes any lower,
Mm.
but think about the prospects over the next 1 to 3 years. I think that changes the picture.
Yeah.
So, but you have to always balance those risks. You have
Mm-hmm.
that stock. Disney is going to suffer because of the recession. You have other stocks that are going to do well, even if it takes longer than expected, like the Amazons, the DocuSigns, the companies that are going to keep growing and are going to even benefit from the pandemic.
Mm-hmm.
So that kind of balances your exposure.
Yeah.
And also cash. Cash is king.
Right. Yeah, absolutely. And we know they bring in cash and pay a dividend as well. Um, so I wonder how you look at Disney, because I know you have a very specific system, that you talk about quite a bit in the Data-Driven Investor, in the group that you have there. Do you see it as, a kind of a traditional value investment, or is it now becoming, is it still growth, or is it an innovator with Disney Plus, or is it a sort of a combination of all these things?
I would say it's mostly a quality stock because it has really a solid financial performance. But in my opinion, the thing that truly differentiates Disney from the rest of the companies in the industry are the things that you don't easily see on the balance sheet, like the quality of its intellectual property,
Mm-hmm.
the company's ability to build brands around those intellectual properties, and then to
Right.
monetize those properties through parks, video games, online video,
Mm-hmm.
movies, so sequels from successful characters. I
Yeah.
think that's pretty unique. And we're going to have a recession, and the smaller players, the smaller studios, movie studios, they're going to suffer much serious consequences at Disney.
Mm-hmm.
And over time, they tend to get stronger. So I wouldn't be surprised to see Disney acquiring more intellectual
Mm-hmm.
properties, consolidating its already strong position in the industry.
Yeah.
So I think if you're going to buy Disney, you have to be prepared for a lot of volatility and even some uncertainty. The company, they took a lot of debt with the acquisition of Fox, so that's a major risk factor to keep in mind.
Mm-hmm.
This means you need to keep your position in Disney at a moderate size in case it goes lower, so you can buy more. And you
Mm-hmm.
have to be patient. You have to think about it over the long term. But I think when you consider both risk and reward, and you do it in a long-term horizon, I think it's worth it.
Right. Okay. And that makes sense. You mentioned just the power of the franchise, the brands that they own, and the intellectual property. I think in at least one of your articles, you've compared it to Coca-Cola, where, I mean, when I think of that, and Warren Buffett and these guys, he mentioned, if a company can own a piece of your mind, right?
Yeah.
If a company can tap into your emotions in a way that Coca-Cola does it well, See's Candy he talks about, and
Mm-hmm.
Disney, I mean, there's nothing like the Marvel universe and Star Wars, and I mean, there's others, but if you want Star Wars, you have to go to Disney. If you want um, you know Toy Story, you can only get it from Disney. So I think that makes a lot of sense when you put it that way.
Oh, yeah, it's an excellent comment that you make because there's something about the emotional connection
Mm.
that the consumers have with the brands and the intellectual properties in general, and it's also an intergenerational company. So it's like
Mm.
you enjoyed this content from Disney, your kids will, and you cannot buy
Mhm.
that.
Yeah.
Even if, like Warren Buffett said about Coca-Cola, if you give me $1 billion, you tell me to replace the brand, it's
Mm-hmm.
impossible to do. I think that you cannot replace what Disney means to consumers, even
Right.
with unlimited amounts of money. It takes time and it takes human talent and it takes history to do that.
Mm-hmm.
So that's kind of the things that make a great company, and those things are reflective on the numbers in the long term, but
Mm-hmm.
they are not easily observable on a quarter-to-quarter basis, and especially in a recession.
Yeah.
So the main point is, focusing on the big pictures and the main competitive strengths that are going to generate value for shareholders
Mm-hmm.
over several years and not a specific quarter. I mean, that's my thesis for this particular stock, right?
Mm-hmm.
In other cases, you can keep other considerations in mind, and it's okay. I don't think that you only have to look at the big picture and the long term. Some investment opportunities are mostly paid out over short-term periods of time. It's okay. I'm not against that. But in this case, if you're going to buy Disney, it has to be with a long-term approach and by focusing on the big picture, the main fundamental attributes of the business.
Right. No, that makes sense. It kind of is second to none, and it's, the leader in its entertainment industry. Anything else that you're looking at? I know we've talked a lot about Disney, and I know it's very interesting reading your article on Seeking Alpha about it. But what other types of companies are you talking to people about looking at, or at least industries that may be undervalued? Because I know you mentioned things are not necessarily undervalued right now. They've come down just from recent highs. But are there other sectors or other areas that you think are interesting to look at?
Oh yeah, I think there are many interesting opportunities. I have a big position in Amazon. I think Amazon is arguably one of the best companies in the world. It has probably the most um, innovative CEO around. It has an excellent management team, rock solid competitive strength. And when you start looking at the numbers, I don't think Amazon is too expensive at all. Um, you know, it's tricky because the company invests a lot of money for further growth. So you need to take a deeper look at the earnings and the cash flows. And it's a matter of discussion. I understand why some people will want to not buy Amazon.
Mm-hmm.
But if you're willing to invest in a company that is not making lots of current earnings because it's maximizing long-term cash flow generation, I think that Amazon is a great candidate. And I have a lot of confidence on the fact that the company is going to be generating more cash flows in the next year and in the next 5 years and in the next 10 years. So it's going back to Warren Buffett. Time is the friend of a wonderful business. So when you have a wonderful business, you know that you can buy in size and you can hold on to the position. And if it gets much cheaper, you can buy more.
Mm-hmm.
So that's kind of like a good stock for all kinds of investors. It's a growth stock, and it's not probably the traditional value and more conservative stocks.
Mm-hmm.
But I think it's not too risky, and it doesn't have too much COVID-19 risk. Then I have like other kind of more risky positions. I like lots of names in software, such as Alteryx and the Trade Desk that makes programmatic advertising. It's a great business model, and we just heard from the company CEO. They said that when they were asked about the impact of COVID-19, they said, well, yeah, the advertising industry in general is under pressure, but we're seeing that a lot of advertisers, when the industry is under pressure, they start to focus on what they can measure, the kind of advertising that can add value. And programmatic is very efficient in that way. And a lot of people are spending a lot of time online and watching video and watching movies. So, the company is doing really, at least much better than previously expected. And that's a big sign for me, because when you see that the business is doing well in tough times, that tells you a lot about the underlying qualities of the business, because even a mediocre company can produce solid numbers when the economy is growing strongly.
That's a good point.
But you really need a special business with a good management team, a resilient business model to produce solid performance when everybody else is under pressure. I think that recent numbers they didn't give us their numbers, but the comments from the CEO, I think they are very encouraging, showing that the Trade Desk is a really strong business. I also have a position in Livongo Health. That's a much smaller company. It makes I would say it's in the intersection of technology and healthcare. It uses technology to modify the behavior of patients with diabetes and overweight and high blood pressure. And it's really interesting, because when you think about it, I have a big issue in healthcare is that the most important thing is modifying the behavior of patients. I mean, when we talk about chronic conditions, right? But the problem with that is that, for example, I know that eating an apple is healthier than eating a piece of cake. The problem is that the piece of cake is much more is much tastier right now, and the benefits from the apple, they come over multiple years. So making those decisions is really tough. But with companies such as Livongo, you can measure what the impact of the piece of cake is on your blood, on your insulin, on your blood pressure. So it gives you the instant feedback, and you can talk to your doctor, and they tell you, well, okay, you have been eating too much sugar, you need to cut down. So I think that if you can do that, you can modify the behavior of patients. It's a major revolution in healthcare. And Livongo, they have the data to prove that the technology works. They are reducing healthcare expenses. They are producing solid results. Of course, it's really a much riskier proposition than Amazon or even Disney, but it's highly innovative, and I think it has a lot of upside potential.
It seems to fit in line, and I'm not familiar with it, but it sounds like it falls in line with a lot of, the world is opening up over the past number of years. That people's minds are opening up to other areas of wellness, eating healthier, being more active. It's not just about creating a pill to solve some medical condition. So if governments embrace that kind of technology, that sounds pretty incredible.
Yeah, absolutely. And I think that Apple is another company that could benefit from that. I think they have great technology, and they are like on track to build the applications and the services for permanent health monitoring. And that's really, I think, a really, really interesting area, because, everybody's like kind of focusing on the market durations in the short term, the panic, what the Fed is doing, the bad economic reports. And it's really easy to miss the forest for the trees. So you have to say, let's take a step back and let's start thinking about the great things that are going to happen with or without this pandemic. This pandemic is going to be over. I don't know exactly when or how much it's going to hurt the economy, but it's going to be over sooner or later. And many companies are going to continue building amazing things. So the investors who can, keep their heads cool and pay attention to long-term trends with big potential, I think, like they say, fear creates opportunity.
Yeah.
But also, in order to capitalize on those opportunities, you need to keep your overall portfolio risk under control. You have to be comfortable with your risk. So I think when you get a market crash, it's a great time to buy stocks, but also keeping your overall risk, your portfolio risk. I mean, when looking at the whole positions and when considering cash, when considering hedging, you can use futures to hedge your portfolio. You can use options, whatever works well. But having an active risk management framework is what allows you to not only protect your portfolio from the downside, but also to play more offense. When you have the defense figured out, it gives you more confidence to play offense. So you can buy some stocks that are risky or that are going under pressure, because you know that you are not going to lose a massive amount of money overall in your portfolio. That's a balanced approach, in my opinion.
Yeah, you mentioned your feelings that you have during this, right? Because if it sounds like if you mismanage your emotions, that's where you make big mistakes too, whether or not you actually have a high risk portfolio or not. If you see it go down too fast or something, it scares people and they sell. Talking about risk and tolerance, the tolerance that you have for that risk.
Yeah, I think it's crucial to have a plan. It doesn't have to be a perfect plan. Nobody has the perfect plan. Nobody sells at the top or buys exactly at the bottom. But you have to have a solid plan. It has to be consistent. It has to be something that works in the long term. And you don't have to aim for perfection, because aiming for perfection is going to ultimately hurt you. It's going to backfire more often than not.
Yeah.
Just build a plan that goes well with your risk tolerance level. You have to, before you buy a stock, you have to think, okay, what am I going to do if it goes down? What am I going to do if the whole market goes down? maybe you're going to keep some cash on your portfolio. Maybe you're going to protect yourself with puts. Maybe you're going to hedge with futures or with ETF or whatever. Maybe you're going to wait. It's okay. It's a perfectly viable alternative. But please make sure that you have a well-established plan. If the plan is waiting, then you're going to have to wait, and you have to keep, you have to make sure that you will not need to sell the stocks in a bad time. You need to have cash reserves outside of the stock market in case you need money.
Yeah, of course.
So, as long as the plan is solid and consistent, everything goes. The most important thing is that it has to be in accordance to your own risk tolerance level.
Right. So there's no right or wrong. I mean, there is some right or wrong, but there it still has to fit, I guess, what you would call your circle of competence or your circle of comfort or whatever, right?
It has to go with your personality. And a lot of people, when they don't really know, I mean, after a long bull market, a lot of people, they don't really know what's their true risk tolerance. I guess many people, they found out in the recent market crash, because if you weren't investing in 2008 or 2009, or you had little money in the market back then probably you didn't suffer any big market declines. The recent experience was probably a good tell of your true tolerance to risk. And again, you don't have to try to build the perfect plan, but you cannot just be speculating like, oh, now I'm going to buy, now I'm going to sell. Just build a plan. Build a plan. It has to be consistent. I mean, avoid leverage, avoid doing dangerous things. Just be consistent and make sure that it works for your own risk tolerance levels and your own time frame. I think there's two key words here: consistency, and it has to be right for you.
Well, thank you very much. I really appreciate your time. This insight is incredibly powerful. And again, I just want to mention your data-driven investor newsletter and group that you have on Seeking Alpha. I think that's an incredible resource if people want to learn more about you. Thank you very much.
Thank you very much. Really appreciate it.